Hey guys, welcome back. So today I'm going to be discussing Bitcoin, and it has been crashing like the rest of the market. It should not be surprising the magnitude of the crash since all other assets have been getting hit, and typically Bitcoin gets hit a lot harder because of its high beta comparable to other assets. So if we see the NASDAQ and other growth stocks, which are more risk assets, have been getting really hit, and this is why Bitcoin is down that much. Now, when you also look at it, Bitcoin very much is a hedge against inflation, and because interest rates were so low and inflation was running high, people saw Bitcoin as a hedge against this. Now that the Fed is going to fight inflation by raising interest rates and through quantitative tightening, it does make sense that individuals are seeing that this is the direct reason to why Bitcoin will go down. So it creates more pressure on this asset. Now, in this video, I'm going to talk about whether I'm buying the dip. I'm going to just explain a little bit about Bitcoin. I feel like there's enough videos out there about what Bitcoin is, so it'll only be a small kind of portion, and how Bitcoin should play a role in one's portfolio if it should. Please like and subscribe to support the channel, and let's get into the video. So first off, I want to start by saying that I am currently not yet buying the dip. And the reason is because I have my allocation already towards Bitcoin, which I started to buy in the 17 to 19K range. And I am kind of happy with my holdings. However, if it continues to drop, then I will be buying more. The levels which I would be buying is starting to look at it under 30K. Now, this is not investment advice. However, I do believe, in my opinion, that every portfolio can have a bit of allocation towards Bitcoin, but it has to be met by two conditions. The first is it has to be a long-term position. It can't be something that you're looking for in the short term to make a crazy amount of money. And the reason is because in the short term, we really can't predict where it's headed, which means if it's headed downwards and you didn't buy it for those longer-term reasons, you will probably end up trading it out at the worst possible time, thus losing money. So long term is number one. The second is it can't be money that you absolutely can't lose. And I say this because at the end of the day, Bitcoin is a riskier asset, and I really believe in the technology behind Bitcoin. I believe in its use cases. I believe in the potential use cases that will form over time. However, we have to understand that not everything that makes sense and is more efficient and will provide utility to society is automatically adopted. And we can look at, for example, cigarettes. The companies, because of the outside influences, made it that for years they wouldn't put the actual damaging effects on it, and it continued to, people think that it's good. And the same with seatbelts. The car industry for so many years were against putting in seatbelts and showing that it wasn't really safety, and this is because of the outside kind of effects. And I think the same with Bitcoin. Even though it has all this, provides all this utility, there's still that outside manipulation and not understanding of what it is that can create the asset class not to form the way I think it will, and really it is. But this is why I just think you can't put money that you absolutely cannot lose. However, in every portfolio, putting 1%, 2% towards it is totally fine, even if, I mean, it's money you can't lose, but it's a part of a bigger portfolio that would be diversified and over time should perform well, even without the Bitcoin, although I do think Bitcoin is here to stay. So the reason why I would invest in Bitcoin is because at the end of the day, every investment, it's about the risk reward. And when something has a higher risk, which yes, Bitcoin is a riskier asset, the reward potentially is much greater. And when we look at the reward of Bitcoin, it is a technology that really could disrupt the financial industry the way we know it today. And if we look at even just equities and bonds, we're talking about an over $200 trillion market in the US alone. And Bitcoin right now is, I think, back down to 600 billion. So not even a trillion. Gold is at 9 trillion. We're talking about a fraction of the financial industry with a technology that has the ability to really disrupt the financial industry the way we know it. So its upside is, 10x or more, depending on its use cases, which we can get into. And this is why I'm invested in it. I see definitely the risk. The technology is incredible. It's not certain that it will take form the way I think it will, although the evidence is there that it is in terms of user growth and transaction growth and all that. But the reward is incredible. And that's why for me, even like I have more than 1 or 2%. I've over 5% of my portfolio allocated towards there. I have a very small portfolio in positions that I have very high conviction on. Bitcoin, I have high conviction, although I still see the ability for it to not take form. So it's not like a Tesla position where for me it's like the clear pathway to trillions. Anyways, so what is Bitcoin? So Bitcoin is basically it's a software that is working off CPU power in order to think of it protecting an Excel sheet that is an updated ledger that takes into account every transaction that's on it. So there's 21 million Bitcoins, okay? And it runs off the CPU power globally, so anyone can opt in around the globe to let the network run off it, so it decentralizes the control aspect. There's no central bank or Federal Reserve that's in charge of it. It's capped at 21 million, so there's also no central bank that can just print money and inflate that currency. And let's say I have Bitcoin and I send it to someone. It is it operates on this CPU power, and it will in real time update the ledger to taking that amount off my account and putting it to the next person. And it really just takes away this intermediary and the central point of control, and this lowers transaction costs. You're able to do it on any day of the week, and no one's in charge. You're sending your money to someone else, and you can do it at any point in time. And it also is your own property, because there's no one that, like, if you have Bitcoin and you put it on a USB, for example, it's just numbers that are providing you with that address of what you have in it. You can put it away, take it out 20 years later, and obviously the network has to still be there, and it will still be there. And let's say a government wanted to, in another country, emerging markets or whatever, wanted to say no one can hold this amount of money anymore in this currency, or we're devaluing it and all that. They just don't have that control. You still have your Bitcoin. You can move to another country 10 years later, again, as long as the network, which we'll get into, is still there. You plug it in and boom, your Bitcoin's still there. Now, when it comes to that network, the network is like the ability to hack it, which hasn't happened in 12 years, or damage the network, gets increasingly harder every day. And the reason is because in order to do it, you need more than 50% in order to agree upon doing something to the network. So first of all, every day, more and more CPU power is put towards that network, which makes it harder and harder to get 50% on board to do something to the network, because remember, it's distributed around the globe. So you have to get all of them on board to do something specific when it's distributed globally. And the second part is, even if you got them all, it's in their best interest for the network to operate efficiently, because with each transaction, which each mine Bitcoin to get to the 21 million, which we're at over 18 million today, they get a piece of Bitcoin, which is basically money paid out in order to operate the system. So if they make the system, if they damage the system, then they're just damaging themselves, because the money that they paid out or won't is losing value. So it's in their interest. It's a system that makes it interesting for the people to use their CPU power towards protecting the network, because they get paid out, and then us operating on the system because it's our property that we can send around. And when you think of it like, it's not tangible, so how could it have value? I mean, Google, Facebook, Uber, these companies, it's not about tangibility anymore. These are software companies, and their value is based on the network that they created, right? Facebook, it's all about the network between people sending messages and connecting back and forth. So here it's the exact same thing. The technology is there, the software is there. It's a beautiful system in the way it works. Now more for a store of value, that you can just put your money in that. It's not getting inflated by governments printing money. And as the network is growing, which, I mean, there's billions of transactions taking place on the chain today. There's the amount of wallets has gone from thousands or really nothing in 2009 to over 80 million today. Like, we see it adopting that network. And as that network continues, the same way Facebook has almost $1 trillion market value and Google has 1.5 trillion, this network is so much bigger, because we're talking about a financial industry with people just looking to put their money somewhere, which is over $200 trillion. And then there's still the real estate market and all that. So when it comes to the value, it's the network. And we clearly see that network growing. And the intangibleness argument is, I think, more for the older generation, people who can understand like what it means to have value if it's not something you can touch. And when we look at like comparing it to gold, the reason why gold has become the store of value for people is because of its scarcity. So typically scarcity works that and you can look at it as other assets, typically if something's in higher demand, then people will go out and mine more of it. So let's say oil. If the demand for oil goes up, the price for oil goes up, and that leads to people be willing to mine more oil because it's worth it to put that labor work into it because of the prices of oil. But once they put that in and they start mining more, the prices come crashing down because then there's an oversupply. So you always have this kind of thing that usually leads to equilibrium. When it comes to gold, no matter how high the demand of gold goes up, it's such a hard thing to mine. So even if you wanted to put all your mining power towards it because the gold price went up, you still only can mine a certain percentage a year, which that's why people kept it as that store of value. Now, when it comes to Bitcoin, we're talking about it's 21 million. So it's also capped, if anything, more than gold, because gold you can always mine every year, a few percentage points. With Bitcoin at 21 million, it's the max. You can't mine anymore. And with gold, you can't send someone gold. Right? You're going to send a block of gold to someone. You're going to hold your blocks of gold in your basement. I mean, that's very risky. So you have to trust this. And most people that invest in it are trusting an intermediary, which is going back to that bank that they say they have their gold, but then you have these fractional reserves and they print more than they really have. So you end up kind of trusting this intermediary that's shown throughout history that is not really the most trustworthy, as opposed to having this software on a USB or on this address that's completely yours, and you can send it across the world within 20 minutes. So really, it adds the scarcity aspect of gold, but it also adds the ability to transfer it that gold really doesn't have. And this is why in a world where software is eating it, and in a world where the next generations are understanding that yes, not everything has to be tangible. We're in a technological world. This really solves so many points of really when it comes to money, but here I'm focusing more on the store of value, which in and of itself gives Bitcoin a value of at least 10x from here if it would get to what gold is. And I think you also have to get out of your mind like I'm in an emerged market, which is the banking system and the government, it's definitely a lot more stable. But in emerging markets, think of it, you're in Turkey, Venezuela, like one day you wake up and your currency just is devalued like crazy, worth nothing. Imagine you had money there. Like it's very difficult to keep it in the currency if you have an alternative option, which usually, even if it's US dollars, then it's within the bank and the government could come in and ban that, which happened, for example, in Argentina. But when it comes to Bitcoin, again, you're holding it on this USB chip, you put it away, you can really keep that value, move to another country one day, or wake up in 10 years or your kids in 50 years. And again, as long as that network is continuously there, which the CPU, like all you need is one CPU that continues to let the network operate, but now it's just growing every year. And as long as this takes place, then these people in the emerging markets really have an answer to where to store their money. And like, I think that if you want to hold it, you have to hold it for the long term. I think you want to be holding it more than just, oh, it's going up, so let me hold it. Because then you end up not holding it for the right reasons. You might sell it at the wrong times. You really want to understand the technology. A book here that really gets into kind of how it can disrupt the financial industry, the Bitcoin Standard, an incredible book. I think it's great to do your due diligence, your research on it, and allocating a small portion of your portfolio, in my opinion, not an investment advice, is not a bad idea because of the potential outcome that Bitcoin can have on our society. Thank you so much for watching. Please like and subscribe. See you in the next video.